Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is June 8th of 2021. We're going to go through three topics that we're following here at Blanke Schein Wealth Management that are important to the market. So let's get right to it, and thanks for watching. Our first topic out of the gate, the S&P 500 right now is inching close to closing at another all-time high for the S&P 500. Now, if we look back at the last 5 years, historically speaking, what we've seen since back to 2016, if you will, is 180 all-time high closes. Oftentimes clients ask us, well, wait a minute, clients or the markets are closing at all-time highs. Yeah, for good reason, right? And that doesn't mean that a correction at some point in time is not down the road, but also it doesn't mean that it can't keep persisting to an all-time high on a go-forward basis, as evidence as when we had an all-time high 5 years ago, we had another 180 plus closes since, and that averages about a 3 all-time close new high per month if we just take it over the course of the last 60 months or so. That being said, we're constantly looking at economic data to see the state of the economy to support the markets on a go-forward basis. So this morning we got a JOLTS report. It's basically a job openings labor market report, and it set an all-time record at 9.3 million openings in jobs. I don't know about you. We're here at Blanke Schein Wealth Management, we're hiring, but it's a tight labor market out there. In fact, you could go across the street right now at our local McDonald's, and there's $17 plus an hour plus $100 signing bonus. We're hearing that all over the United States, not just here in California. So we also had sort of a client of ours who is in the hospitality industry on an executive level, and she said yesterday that they can only open up as fast as they can get people to come back to work. So there's a shortage right now, but there's also a capacity utilization right now that's just overwhelming this labor shortage right now that we're seeing. So as evidence that corporations in the JOLTS report, 9.3 million, are new offerings out there in the marketplace. This is huge. That's a really sign of a strong economy, and then that sets up for possibly newer highs for the S&P 500 and all the indices. Now, one of the things that we're also looking at is, as I keep bringing back to the forefront, is the Federal Reserve's take. Janet Yellen this last weekend, who is the Treasury Secretary, but formerly in the Federal Reserve Chairman board position as well, years back, she made mention that higher interest rates aren't a bad thing for the economy. She was on a talk show on Sunday in Bloomberg, and Monday morning the S&P sort of sold off as a result of that because it sort of spooked the market. And later this week, we have all the Fed chairmen, Powell and a few others, around the United States giving speeches. And what we talk about that is talking about that. What that specifically means is talking about raising interest rates. So they're not at raising interest rates yet. What the Federal Reserve strategy now on a go-forward basis, and then next week we'll see when the FOMC meets and then ultimately releases their update in their news press conference, is the change in talk, and you're seeing it across the United States and all of the Federal Reserve members as they give speeches out in the public. They start warming up to the idea of thinking about how to raise interest rates by way of withdrawing the bond purchases or tapering the bond purchases. The reason why this is important on a go-forward basis is, if you recall back in 2013, there was the tape tantrum or the temper tantrum, where the Federal Reserve started raising interest rates and sort of fumbled that step at that time, and markets sold off as a result of that because it was too early, too quick, and not enough sort of communication on a front-end basis. So the Federal Reserve is learning their lesson from 2013, and they're going to talk about talking about it before they actually do it. And we anticipate interest rates potentially rising maybe later this year, but more importantly, we think definitely next year on a go-forward basis. But they have to talk about it before they actually do it so that markets can adjust and adjust accordingly. Now, if you go back to the CPI, one of the reasons in catalyst is the consumer price index, so inflationary read, if you will. So the Federal Reserve is taking a look at that, but it's nothing like the 70s and 80s. If we go back to the 70s and 80s, 1965 to 1980, we had the CPI reading around 4% that went all the way up to about 15, under 16%. And then we also had, the prime interest rate to 21.5%, and the Federal Reserve Chairman at the time, Paul Volcker, had to break the back of inflation because inflation was taking off. We're nowhere near the 70s and 80s, if you will. because CPI is just over 2% as we speak. But we also want to be cautious of where we are relative to where we could be. And we're seeing a lot of hot inflationary data that is coming our way. And again, the Federal Reserve constantly says it's transitory, which a translation temporary, because of the supply chain constraints. As you turn on the US economy, you can't just turn on like a light switch. There's going to be supply chain constraints from start to finish. So that's what we're working through: hot inflation numbers, hot CPI numbers, but again, nowhere where we are the 60s and 70s and 80s, if you will, if we look at putting today's numbers in a historical setting. So that's ultimately the update that we have for today. We're going to see next week some important information from the Federal Reserve. But we're looking at the S&P 500 and all the indices getting close to all-time highs as corporations conceivably could make money in this interest rate environment, potentially rising. That being said, you want to be on the pro-cyclical side of the S&P 500 and those companies that could do well in inflationary environments. So that's what we do so well here at Blanke Schein Wealth Management. We make sure that you're well balanced. We make sure that you're positioned appropriately for all this information, all this economic data, what's to come. And there's a lot of companies that can continue to thrive, in fact, do really better, a lot of sectors, when interest rates are in a rising environment. So we're seeing value outperform growth. We're seeing energy as well as financials, and in the insurance world as well, in financials, they catch a bid or they continue to outperform. So we manage portfolios appropriately and rebalance proactively to ensure that we're constantly staying ahead of the game, using all this information proactively. So thanks for watching. We'll see you again next time, and take care.